and then the New York session. Currencies. In Forex, you trade currencies. You're not buying the physical yen or euro, but you're speculating on their values. It's almost like buying a share in the economy of various countries or selling one. Major currencies are the ones that are traded the most because they are made up of the largest economies in the world. They are USD, the United States dollar, also called the buck, EUR, the Eurozone euro, also called the fiber, JPY, the Japanese yen, GBP, the Great British pound, also called the cable, CHF, the Switzerland franc, also called the Swissy, CAD, the Canadian dollar, also called the loonie, AUD, the Australian dollar, also called the Aussie, NZD, the New Zealand dollar, called the Kiwi. You've probably noticed that they all have 3 letters called the ISO 4217 currency codes, established by the International Organization of Standardization, ISO, in 1973. The first 2 letters are made up of the country's name, while the last one is the currency's name. You trade currencies through a broker, and they are always traded in pairs. This is because each one is quoted relative to another. For instance, you have the popular euro against the US dollar, called EUR-USD. Then there's the Swissy against the yen, which is CHF-JPY. So you can only ever trade Forex in pairs, buying or selling one for the other. There are 3 kinds of currency pairs. The majors, which always have the US dollars as one side of the equation, the crosses, which do not have the US dollar ever, also called minors, the exotics, which have one major currency paired against an emerging economy's currency. In Forex, the price of major moves a lot more than the exotics and the crosses, as they are the most traded pairs. This means you'll get a lot of trading opportunities with them. They are EUR-USD, Euro-Dollar, USD-JPY, Dollar-Yen, GBP-USD, Pound-Dollar, USD-CHF, Dollar-Swissy, USD-CAD, Dollar-Loonie, AUD-USD, Aussie Dollar, NZD-USD, Kiwi Dollar. The majors are the most liquid pairs you can trade. When I say liquid, I mean that they have a lot of financial activity. So the next time you hear the word liquidity, you'll know what that means. A market is liquid because of the volume of trading activity. Crosses and minors. Crosses are pairs that don't have the USD in them. They aren't often traded like the minors, but they are relatively liquid, so they can still give you generous trading opportunities. The most traded crosses are pairs that have EUR, JPY, and GBP. Euro crosses. EUR, CHF, or the Euro Swissy, EUR, CAD, or the Euro Loonie, EUR, GBP, or the Euro Pound, EUR, NZD, or the Euro Kiwi, EUR, AUD, or the Euro Aussie, EUR, SEK, or the Euro Stocky, EUR, NOK, or the Euro Naki. Yen crosses. EUR, JPY, or the Euro Yen, GBP, JPY, or the Pound Yen, also called the Guppy or the Dragon, CAD, JPY, or the Loonie Yen, CHF, JPY, or the Swissy Yen, AUD, JPY, or the Aussie Yen, NZD, JPY, or the Kiwi Yen. Pound crosses. GBP, CAD, or the Pound Loonie, GBP, AUD, or the Pound Aussie, GBP, CHF, or the Pound Swissy, GBP, NZD, or the Pound Kiwi. Other crosses. AUD, CAD, or the Aussie Loonie, or Aussie CAD, AUD, CHF, or the Aussie Swissy, AUD, NZD, or the Aussie Kiwi, CAD, CHF, or the Loonie Swissy, or CAD Swiss, NZD, CAD, or the Kiwi Loonie, or Kiwi CAD, NZD, CHF, or the Kiwi Swissy. The exotics. These pairs have one primary currency pegged to the currency of EMs or emerging economies like Mexico, Brazil, Hungary, Turkey, or Chile. Not every broker offers these pairs to trade, but here's a list of the currencies you may find on yours paired against the US dollar, euro, and pound. The Brazilian real, BRL. The Hong Kong dollar, HKD. The Saudi Arabian rial, SAR. The Singaporean dollar, SGD. The South African rand, the ZAR. The Thailand baht, THB. The Russian ruble, RUB. The Mexican peso, MXN. The Polish zloty, PLN. The Chilean peso, CLP. The Norwegian krone, NOK. The Swedish krona, SEK. There are several other exotic currencies you could trade, but these are the most commonly offered ones. With the exotics, you will find that the spreads are several times larger than with the majors. This is because they don't have as much liquidity, and they're usually a lot more affected by economic events and geopolitical news. For example, if a war breaks out in one of these countries, potentially causing the price of that currency to drastically plummet relative to the major currencies, creating more movement than you could ever find on the majors. This is something to keep in mind if you choose to trade these pairs. Volume. Volume is the amount of the currency pair being traded over time. It's about the number of units that are exchanged between buyers and sellers. There are certain times when the markets aren't quite as liquid as you'd like them to be. In these times, the volumes of trades are too low to make anything out of it, unless your trading strategy requires that you have low volume and liquidity to begin with. Volume is essential because you need it to confirm that the patterns you see on your charts are actually valid and that the market is really moving in the direction you think it is. When there are significant changes in the asset price with high volume, that means the move is more important, and you should look for ways to get in on that. So, volume is beneficial when you're analyzing price movement. Trade anywhere, anytime. The Forex market isn't like the London Stock Exchange or the New York Stock Exchange, where all trading happens in one location. Instead, this is an over-the-counter market, which means it's all done electronically, on the interbank network, 24 hours a day, and for retail traders, 6 days a week. As long as you have an internet connection, then you can trade. While you can trade whenever you want to, a good rule of thumb is to avoid trading on Sundays, Mondays, and Fridays. On the first 2 days, the market needs time to determine how to respond to weekend news, and you should also allow it to show you where it wants to go. On Fridays, the volume can be low, or there may be too much volatility on account of significant news releases. Bank holidays are an excellent time to stay out unless you have experience trading at these times and a broker who gives you a fair spread. Finally, do not trade significant news events. You can tell when they're about to happen by going to Forex Factory's website and checking the news calendar. Anything flagged as high or medium means you should stay out until at least 5 minutes after the news release. Getting a broker. When you want to find a broker, you want one with tight spreads. The tighter the spreads, the faster you can get into your profit on your trades, and the quicker you can make them risk-free by moving your stop loss to break even. Also, you want a broker who has accreditation from the national regulatory bodies so that they will treat you fairly and so that you're protected if you and your broker have a dispute that wasn't your fault to begin with and costs you money. Be sure to get familiar with their terms and conditions before you sign up for an account. This way, you already know what you're getting into. For example, some brokers don't allow hedging, trading in both directions, or scalping, entering trades with colossal lot sizes only to get out in a matter of minutes or seconds with a few pips of profit. So, you want to know what's good and what may lead to a termination of your account. Most brokers offer demo accounts so you can paper trade or demo trade and get a feel for what trading is like. Now, you should keep in mind that demo trading isn't the same as live trading, psychologically or financially. The demo trading lets you get used to the trading platform, practice your strategy to see how viable it is, and test other parameters with your trading. You cannot withdraw demo money. If you could, we'd all be retired. Also, you'll find that you might get excellent fills on price when trading the news with a demo account, but this is not guaranteed when you're in the live markets with real funds. This is just something to keep in mind if you stubbornly decide to trade the news. Check out the reviews for the brokers before you choose one. You can look them up on Forex Peace Army. You want a broker with good reviews, but be careful that they aren't paid reviews. You'll know it's fake when they all sound generic or come on the same day or from the same place. Also, a good broker will usually respond to any negative complaints or issues on the forum, intending to clear the air or fix any problems. If they're still replying even now, chances are they are a broker you can trust. Good brokers also offer you various trading platforms, from the tried and true MetaTrader 4 to MetaTrader 5, Android, Apple, web, and desktop versions are usually given, to the sleek and modern CTrader, also available for phone, desktop, and web. There are two kinds of brokers, the market makers and the electronic communications networks, ECN. The former set their own prices with the ask and spread and manipulate prices to take out stop losses. The latter use the best ask and bid prices they can get from interbank institutions and usually charge a tiny commission for your trades. It's up to you to work out which kind you prefer. Beware that some brokers go rogue, manipulating their prices to rip off traders, slowing down execution time for your trades, refusing to honor your stop loss and take profit levels, and more. So you really should take your time when choosing one. I won't recommend a broker in this book, but if you do your homework and follow the criteria given here, you'll find a great broker to trade with. How you make money trading Forex. You make money by selling or buying currencies. In Forex speak, going long on the euro-dollar means you're going to buy the euro, expecting that it will rise in value relative to the dollar. Going short on the euro-dollar means you expect that the euro's value will fall relative to the dollar, and so you will sell. You may also hear the terms bullish and bearish. Buyers are the bulls in the market, pushing prices higher, while sellers are the bears. When you have no positions running, that means you're square or flat. The point of trading is to make money from the price difference. If you're bullish on the dollar versus the loonie, that means you expect to make money as the price goes higher from when you placed your trade. When you're bearish, you hope to make money as the exchange prices between those currencies goes lower in your favor. In a bullish scenario, you could buy 10,000 Great British Pounds against the dollar at the exchange rate of 1.17000. GBP 10,000 times 1.17 equals US $11,700. Then a couple of weeks later, the price rallies to 1.2500. So, you liquidate or close that trade. GBP 10,000 times 1.25 equals US $12,500. In this case, you've made $800 profit. The exchange rate between both currencies in GBP CAD show you how many pounds you can buy with $1 Canadian or how many loonies you need to buy £1. Base and quote currencies. To trade successfully, you need to know how to read the Forex quotes. As mentioned before, they always are written in pairs. The first currency in a pair is the base currency. For example, the base currency in EUR and OK is the euro. It is the reference currency and is always worth just one. The second currency is the quote currency, also called the counter currency. In our example, that would be the Norwegian krone. So, the exchange rate lets you know how many units of the quote currency you will need before you can buy 1 unit of the base currency. So if the price of EUR USD is 1.77351, that means you need to pay 1.77351 US dollars to buy 1 euro. When you're selling, the exchange rate will let you know how many units of the counter currency you will get for selling 1 unit of the base currency. This means you will get 1.77351 when you sell 1 euro. There is a standard for quoting Forex currency pairs that all brokers respect, so you never have to worry about which one is the base or the quote. Just know that EUR USD will always be EUR USD, not USD EUR. There may be a slash, a dot, or nothing at all in between these currencies listed on your broker. In the end, it's all the same. Chapter 2. Your Forex Account. The Spread. Bid and Ask Prices. Forex quotes always have two prices called the bid and the ask. The bid is the price your broker offers to exchange the base currency for the quote. It's the price the broker buys from you when you sell. So to keep this simple, anytime you sell a pair, you will be offered the bid price. The ask is the price at which you exchange the quoted currency for the base. In other words, It's the price you get to buy the currency pair at if you choose to get into a trade. The spread is the difference between the asking price and the bidding price. So if you put a trade on, you will always pay the spread. When you want to sell GBP USD, all you do is click the sell button and you will be offered the bid price, which shows up as a line on your chart. When you buy GBP USD, you'll get the asking price. The bid price is always lower than the asking price. It makes sense because if you're going to make a profit, you should buy low and sell high. You want to make a profit, and so does your broker. One of the ways they make their money is through the spread. That's why when you put a trade on, you're immediately a few pips or pipettes, or points, in the red. Your broker may also charge you a commission for each transaction, especially if they offer really tight spreads. All about pips. Trading is about making pips and keeping them. A pip is the measurement of the change in value between currencies, and it is made up of 10 points or pipettes. But nobody really talks about points or pipettes all that much in Forex. When GBP USD moves from 1.35500 to 1.35510, it has moved by 1 pip, which is 0.0001. A quick note. Some brokers are 5-digit brokers, which means the number of figures after a decimal point is always 5, except for yen pairs, where the digits after the decimal are always 3. These are fractional pips, and they are always a tenth of a full pip. So, say price moved from 1.35500 to 1.35513. That means price moved by 13 points or pipettes, or by 1.3 pips. Other brokers are 4-digit brokers, which means they only use 4 digits after a decimal point, and 2 digits on yen pairs. So in our example, the price moved by 1 pip and not 10 pips. Many newbies make the rookie mistake of saying they made 100 pips when they really made 10. To give another illustration, when the price moves from 119.200 to 119.210 on USD JPY, it has moved by just 1 pip. If it moved to 119.213, then it moved by 1.3 pips or 13 points. Calculating pip values. Every currency has its own value relative to others, which means every currency pair pays out different amounts. Assume that USDCHF is at 1.0400. This means 1 USD equals 1.04 CHF. To calculate the value change of just 1 pip, you divide that pip by the exchange rate value and multiply it by 1. 1 pip equals 0.0001 CHF. Exchange ratio equals 1 USD divided by 1.0400 CHF. 0.0001 divided by 1.0400 times 1 equals 0.00009615 USD per unit approximately. So if you trade 10,000 units of USD CHF, then when the price changes by a pip, that would be a change of USD 0.96 approximately. Your trading account could be in a different currency other than the dollar. This means you need to work out the value of a pip differently. Just divide or multiply the pip value you arrive at using the method above by your account currency's exchange rate position. If this all seems a bit too much for you, don't sweat it. Your broker already automatically works it out for you, and you could always go online to use free pip value calculators. Lots. The amounts you trade in are known as lots. These are the number of units of each currency sold or bought. Lots are how you measure the size of your trade transaction. Every time you put an order on, it's quoted in lots. The standard lot size has 100,000 currency units. The mini lot size has 10,000 currency units. Micro lots have 1,000 currency units. Nano lots, rarely used, have 100 currency units. Some brokers forego lots and show you the value of your trade in currency units, but lots are really a lot more convenient. For you to take advantage of the movement and price of pips, you need to have access to large amounts of currency before you can gain actual profits, or make significant losses, because that happens too. If you're using a standard lot, let's see how that will change the value of a pip for you. If USDJPY is at an exchange rate of 118.90, 0.02 divided by 118.90 times 100,000 equals GBP 8.4 times 118.90. If USDCAD is at an exchange rate of 1.5000, 0.0002 divided by 1.5000 times 100,000 equals $6.9 per pip. When the base currency isn't the dollar, the math changes. If GBP USD is at an exchange rate of 1.1830, 0.0001 divided by 1.1830 times 100,000 equals 8.5 times 1.1830 equals $10 per pip approximately. Your broker will let you know the value of each pip on their website, or you can just send them an inquiry. Leverage. The money you trade as part of a retail is nothing compared to what the central banks trade. You can't make any money with it unless your broker gives you leverage. The leverage available to you depends on your broker and your risk appetite. First, you must make a deposit with your broker. This is known as a margin. Then your broker will let you know how much of that margin you need to trade your positions. Say your leverage is 100 to 1, which is 1%